Thanks for joining us. There's quite a few people online already. My name's David. We'll be joined by Helen Collier-Kogtevs very shortly for her webinar today, which is my prediction for Australia's 2019 property market. Would love to know where you're dialing in from around the country today. If you can look down the bottom of your screen, you're probably going to see there's a little chat box. You can chat in there. There's also the Q&A screen, which you can click on as well. And if you have any questions, we'll endeavour to get to them at the end. Helen will be along very shortly, but I would love to know where you're chatting to us from. You pop it in the chat. And I hope wherever you are in the country at the moment, it's nice. There's lots of problem areas around the country at the moment, particularly up in North Queensland. Melanie from Sydney, Neil from Redcliffe, David from Beacon Hill. Hello. Shalib, I hope I got that right. I'm sorry. You're in Sydney. Jimmy in Sydney. Larissa, Central Coast. Vicky, Canberra. Lots of people joining us. We've had a really good sign up for this, so we're going to have a lot of people. But like I said, if you have questions, we've already had a bunch of questions come through already. But if you want to put some in the Q&A box down the bottom, you can, and we'll endeavour to get to them if we have the time at the end. But Helen's got a lot to go through, particularly because it's been such a massive week this week for the banking and finance sector, and she'll cover off on some of that as well. I think I said hello to Vicky from Canberra. Yeah. So look, just before we get things underway, I might just go through the quick disclaimer that we need to pop up. If you can just have a quick read of that before we introduce Helen. Obviously, if you could just have a quick read of that before we introduce her, just to give you an idea. And then we'll jump into it in a second for Helen's predictions for Australia's 2019 property market. I've known Helen for quite some time. Her approach is very direct. We often laugh that it's a no BS approach with Helen. What you see is what you get, and she will tell you the absolute truth and lay it on the line and tell you what she's thinking. So I have no doubt that being the first webinar for this year, that she'll be doing that as well when she jumps online in a second. And like I said, if you can just have a quick flip through the disclaimer, and we will bring her online and she can have a chat here. And naturally, these are some of the places that Helen's been featured in. Look, she's a property educator, but she's also a best-selling author. She's appeared on TV, radio. She's written books. She's a philanthropist as well. And just generally an all-round nice human. Like I said, I've known her for many years, and we should probably bring her into the chat at this stage for my prediction for Australia's 2019 property market. Helen Collier-Kogtevs. Hello.
Hello, David. Happy New Year to you.
Happy New Year to you. How are you going?
Oh, really well. I'm very excited. This is our first one for the year, so it's good to be back.
And you picked a really good day to do it, or a good week to do it, particularly with everything that's been happening in the banking and finance sector. So I have no doubt you'll have a few things to say about that.
I'll have plenty to say about it. In fact, I think when the team chose this date, for the webinar, I don't think they realised that this was going to be the week that so much data was going to be released, that the Royal Banking Commission thing was all coming to an end. So we've got a lot to cover off today. I hope that we get through it all. I have lots to share. And really my intention is to just, as you said, David, is to say it how it is. I'm going to share my opinions. Yep. You might like them, you may not, and that's okay, but I'm here to educate you as best I can. And the fact of the matter is, by everyone being here today tells me that they realise that the strategic importance of getting an education in property, so that they can make the right investing decisions and avoid making financial mistakes. Now, for everyone on the webinar, thank you for joining us. I'm really excited that you're here. We had an overwhelming response for the first one for the year and for the time slot. really honoured that you've all for the reaction that we got. And so what I've done for the first time ever on a webinar, if you stay to the end, I'm going to give you a link because I'm going to share all my research, data and reports as a bonus. So I'm going to give you a link where you can download all the data that I go through during this webinar. So
let's go through what you're going to be talking about.
Yeah, absolutely. So we're going to, I always say you've got to go back to go forward. So we're going to talk about why property. You know, why do we choose property, not shares, not crypto, not anything else? So I want to go through that briefly, and then we're going to talk about finance in 2019, and I have lots to say about all of that. Now, there's some new rules for getting money from the banks, so I'm going to cover some of those off and give you some tips and ideas there. Then I want to go through choosing the right investment property, because I really feel that a lot of investors out there are still not nailing it. And because they're not nailing it, they're ending up now in negative equity situations, poor cash flow positions. And I really want to try and give you some advice around how to maneuver yourself, especially moving forward over the next couple of years. I'm going to look at a whole bunch of data. We're going to look at SQM, we're going to look at CoreLogic, even ABS stats, and we're going to look at rental returns and just kind of I'll give you an overview of all the data and how some of it's conflicting, or well, not so much conflicting, but painting a picture and how to interpret it. Then I'm going to give you my prediction for 2019. And then at the end, I'm going to give you an opportunity to possibly work with me and my team. And then I'll go through all the bonuses with you as well. Nice. So, shall we get into it?
Let's go.
Let's go. So why property? You've got to go back to go forward. Well, here's the thing with property, David. You know, it's consistent over the years. You know, yes, it has its ups and downs, and, you know, we'll cover that off, but it's consistent. And even though right now there is a media frenzy that's going ballistic around, you know, the sky is falling, bloody hell, you know, it happens at least once a year. But now they're making a real meal of it because of the Royal Banking Commission and all of that. But property works in cycles, and the next graph will show you that. And ultimately, property is low risk. Why? Because the banks lend you maximum, you know, they easily lend 80%. Some clients and some people, even myself, got up to 90, 95%. So they view it as low risk. So because they view it as low risk, you know, it's great for us as investors. And the other wonderful thing about property is you can leverage other people's money, OPM, which is lenders. So if you can you know, make 10% on the money you borrow, and it costs you 4 or 5%, then you're ahead by 5%. So, you know, it's trying to leverage that money to make yourself more money, and that's the great thing about, you know, about property. So let's have a look at this graph. It shows you. I don't know if you can see my mouse. Can you see my mouse at all?
I think so.
No?
Yeah, I can.
Okay, so you'll see October 1997. So this is a 20-year span. So I've got multiple screens here, but this is a 20-year span. And over that 20-year span, you'll see that property prices, this is specifically for Sydney, you know, you can see that it goes up. You know, there's peaks and troughs, but if you look at the trend line, it constantly goes up. It's heading in the up direction, even though it might come down and have peaks and troughs, which you want. You don't want that you don't want that huge 20% growth year on year, because it becomes unrealistic. You need the peaks and the troughs to allow you to regroup, for employment to catch up, for wages to catch up, for everything to catch up. And then when it does, it goes off again. So you want the peaks and troughs. It allows people to regroup, you know, allows the market to settle, and then, you know, it goes off again. So we're just operating in normal cycles, which is what we want, and in my opinion is really good news. So what I've done, David, is I went back to the Sydney Morning Herald, 1979. I was a little tacker back then. I don't know about you, may not have even been around. But
I was a very little tacker, but I was a little tacker, yes.
Okay, so back then, you know, I grabbed a copy of the Sydney Morning Herald, and there was a headline, "Home prices to continue rising." Now, how many times have we heard that about, you know, the Sydney market? In fact, you know, go fast forward to 1993. There was another article that I found saying investors return to property. So there was a dip, and now they're all coming back. I guess I want people to understand that, you know, you're going to get peaks and troughs. The media is always going to have a frenzy. They're there to sell headlines. They're there to sell papers, right?
That's what they want to do. That's essentially what they want to do by creating headlines. Yeah.
Exactly. They've got space to sell. So, you know, but it takes guts to march against the crowd. And so when you look at Warren Buffett, you know, one of my favorite quotes was, when everyone is buying, you sell. Yeah. And when everyone is selling, you buy. And so it's having the guts to be able to go, well, you know what? Everyone's crying out that the sky is falling, that the property market's going to fall by, X percent, what have you. And, to some reality it is. But the exciting thing is that, if you can turn around and face the crowd and march against it, we are coming into the most blessed opportunity for buying property, that I've seen in a while. In fact, when you look at downturns last roughly 18 months to 2 years. And so let me give you some examples. So when the Labor government first removed negative gearing back in the Keating days, do you remember that?
Yep.
Do you remember how long it lasted?
Yep.
2 years.
Yeah.
Do you remember when the government brought in NRAS, which was the National Rental Affordability Scheme, and it failed? How long did it last before they removed it? 2 years. Now, when APRA brought in the reduction in the number of investor loans that banks could have, remember they tried to reduce how much, and this was sort of at the start of all of this, sort of slowing of the market, when APRA thought, you know what, Sydney was booming at the time, and what they did was try and bring in this limitation for how much lenders could lend to investors. How long did that last before they've changed their mind?
Am I going to say 2 years?
Yeah, just under 2 years. Yeah, absolutely. Okay. And so now...
That's what you're going to trick me on that one.
No. And those caps, they've actually removed them now. So even P&I, they've realised that what APRA have done, the Banking Royal Commission, the impact that it has had over the last 18 months or so, that all of it has had an impact on the market. Because when you think about it, what's happened over the last 2 years? We've had really strong immigration. We've had really good economic growth. Inflation's stable and strong. Government's stable and strong. That kind of, but fairly.
The leader's not stable.
Yeah, that's right. But our government has been stable. We've kept the government no issues there. But with all of that, even wages growth, unemployment down, we're in a fabulous position. So why the hell has the market cooled off? And it's because of what APRA, the Banking Royal Commission, ASIC, all of that have been doing. It's had an impact on the property market. So here are my tips for everyone listening. You've got to hold on. If it's going to last 18 months to 2 years, and history tells us that everything works in cycles, from the property market to finance, the whole changes to finance, changes to negative gearing, changes to all of that, it lasts a couple of years. So you've got to hang on. And this is where you need to have buffers in place. Use savings, use cash flow, use equity if you have to sustain you while it's all in a bit of a mess. If it means you've got to rein in your budget, great, do that as well. But for those of you that are in a world of pain, you've gone from interest only, you've come off interest only, and you've gone to P&I, bloody hell, that hurts. It happened to me, so I feel your pain. And we had it on several properties all in the same month. Yeah, that was fun nights. So I'll tell you what we did. Sat on the phone for an afternoon, rang the bank or banks, and literally just kept escalating the call, because I refused to talk to anyone in a call centre. Yep. And I found a decision maker, and basically renegotiated the interest rates with them, saying, listen, I've gone from interest only to P&I, and the interest rate's gone up to, I think it was one was 5.19, another one was 5.39, and we renegotiated them back to under 4%.
I heard somebody say that the other day. I was reading that. They said at the moment the banks are the most negotiable they'll ever be, because they want your business. Yes. So you can actually go to them and say, hey, not happy with that rate, give me a discount, and they'll actually do it.
Exactly right. So there's a lot of conversation going on out there that borrowing money is getting harder. We're going to talk about that. It is for those that are not good financial managers, money managers, but it is because a lot of my clients are still getting finance. And I'll talk a bit more about that in a moment. Let's go to the next slide, which is what's happening with finance for 2019. And by golly gee, haven't there been changes galore with ASIC and APRA and the Royal Commission and negative gearing and Labor and blah, 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 blah. Well, they're having a field day. And, on
just for me and for anybody else that happens to be on the webinar at the moment, there's quite a few people. What is it? Can you give it a very, very quick explanation of what's going on?
I'm about to.
Oh, good. Okay.
Yes. Thank you. No problem. So on Monday, I sat and watched the Treasurer deliver the 76 recommendations made by the Royal Commission, and governments agreed with all of them. Now, this is where I'm going to have some personal opinion in all of this, because I reckon agreeing to all 76 of them was ridiculous. I see it as a political move. Guess what's happening in a few months' time? An election. Do you think the coalition right now are going to disagree with the Royal Commission and its findings right before an election? Labor would have an absolute field day going, the coalition are not fit for government. They haven't agreed to the recommendations of the Royal Commission, blah, 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 blah. You could see it, couldn't you? Every bloody newspaper would have it splashed across the front cover, and so I see it as a pure political move. Now, I reckon there are 2 winners out of those recommendations and 2 losers. Let's cover off the winners.
Okay.
The winners are the consumer. So where's the consumer? One of the winners, because the banks are told to pull their heads in and put the consumer first and not profits. Happy days. Yes. Finally, the consumer might be vindicated around the crappy service we've been getting, the bullying tactics, all of that sort of thing. Hopefully now it will stop and the banks are made accountable. However, the second winner is the banks, because I don't think and I don't believe they'll be held accountable. I reckon it's a flash in the pan. It'll last a little bit, and if anyone goes to jail, I'd be surprised. And you know what? I don't think anyone would go to jail, but this is one time I'd love to be proven wrong. Because I think when the banks have gotten away with the really crappy behaviour that they've been displaying over the years, I think it's time they need to start getting a little responsible and pay for it. Because if anyone else makes a mistake, they throw the book at us. But why haven't the banks? They seem to keep getting away with it. Now, of those 76 recommendations, I believe there are 2 losers. The first one are mortgage brokers, and the second one is healthy competition. Now, the reason why I say the brokers are... sorry, I'm still shaking my head because I can't believe what they're doing. So for those of you that don't know, they've removed trail commission from a broker. So when a broker gets paid, they get paid by the bank, and they get an upfront payment, thank you very much, and then they get a very small, what they call a trail commission. So each month they'll get a few bucks for that life of that loan. And on an average, we kind of refinance our loans every 2 to 3 years anyway. And so the broker is now losing that little trail. Now, my question is, okay, if the broker's losing the trail, does that mean they get more up front? And if not, does the bank now keep the trail? That would make them more profitable, wouldn't it, if they're keeping the trail, albeit small? Yeah. So therefore, I go, okay, all right, so maybe the banks are going to win there because the recommendation's not clear on where that trail is going to go. Is it going to be paid to the broker all up front, or is it going to be kept by the lenders? So that's the first thing. The second thing is they are now saying in 3 years' time, they're going to review the whole structure of commission payments from the lenders to the brokers for writing the loan. And I go, okay, they're going to review it with an intention of removing it completely. So, okay, that means the banks are no longer going to pay a trail and they're not going to pay the upfront commission. Okay, so then how does a broker get paid? Well, they're suggesting that they're going to move to fee for service. Okay, fee for service means that I now, as the borrower, the consumer, have to pay the broker to get me a loan. Well, that could be between $3,000 and $5,000. Well,
Okay.
as much as I love my broker and great as I think, you know, the service has been, I'm not going to want to pay $3,000 to $5,000 every time I want a new loan or a refinance or anything else. I could end up with tens of thousands of dollars if I refinance half a dozen loans. You know, sure, I might be able to negotiate it down, but still I'd be up for a whole lot of money. So what that's going to do, and this is where the loser is healthy competition potentially, it means that consumers like you and I are going to go direct to the banks.
Yeah.
All right.
So
therefore, pardon?
It's a lot of jobs.
A lot of jobs. There are 20,000 brokers in Australia. If you annihilate them, that's 20,000 households you're going to impact. That's 20,000 voters, plus partners if there are any, and adult children, that you're going to impact. The government's going to impact by this one single move. But in addition to that, David, what I'm suggesting or what I'm saying is, hold on a minute here, folks. What people don't understand, and in fact, Haynes doesn't even understand. You know, the guy that put forward these recommendations, he doesn't understand mortgage brokering, because if he did, a mortgage broker every year has to pay for a license, has to pay to be a member of the Ombudsman organisation, has to be a member of the MFAA or FBAA to get accreditation, has to maintain PD, personal development, to upkeep and maintain their education, has to do all of that. It costs a broker on average $4,000 a year just to put a sign on their door to say, hey, I'm in business. Not to mention the ongoing costs of working with an aggregator where they process the loans through. So you kind of got to go, okay, so if we annihilate brokers and I've got to go to a bank, when I walk into the bank and I deal with the person behind the desk, are they going to be tertiary qualified? Are they going to be insured with the relevant insurers? Are they going to be members of the Ombudsman, so if I make a complaint, they're protected as much as I am? You know, what will their qualifications be and education be? And with a broker, for a broker to offer me a loan, the broker has to offer me 3 options, has to make 3 recommendations, and I get to choose the one I want. But if I go to a bank, are they going to offer me 3 options? Because a broker is legally obliged to do that. A bank may not have 3 options.
No.
They might just have the one and say, this is it, like it or lump it, this is what we got for you.
And somebody from the National is not exactly going to go, well, you can go to Westpac or Commonwealth and here are their loans. Exactly
right. So all of a sudden now, I'm only limited now to what that lender has to offer me. So they're going to fit me in to a product that may not necessarily be right. So then if you're getting rid of brokers and you're forcing people to go to banks, there is no competition now. Where's the competition?
Yeah.
And the irony is, by cutting out brokers, I see it as a bit of a conspiracy theory. So I'm a conspiracy theorist, for those of you that don't know. I kind of wonder, I go, well, what's behind all of this? Why would the government want to shut down a whole industry? Because it's not just 20,000 brokers. You've got quite a number of aggregators where these brokers, you know, put their loans through to then go up to the lenders. You're going to annihilate them. And then there's the insurance companies and the training companies that support brokers. I can't see the banks making all of their, you know, mortgage people qualified, you know, with diplomas. I can't see that happening. Are they going to open up more branches to handle the workload? I don't think so. You know, they're busy shutting down branches. They're busy shutting down ATMs. Banks are forcing us now to do more online banking and use our credit cards and debit cards. They're shutting down more and more ATMs. So I kind of go, well, what's going on here? You know?
Vicky, Vicky has just actually put up an interesting comment saying, to be fair, then they'd have to bring in the same rules for other brokers, for insurance brokers, exactly, etc. It seems unfair to regulate just one form of broker and not the rest. So it's an interesting comment from Vicky.
Yeah, absolutely. And she's spot on. Why are they targeting brokers? Sure. In all fairness, the Royal Commission highlighted some dodgy players within mortgage brokering. Yes, there are some rogues, but how are you going to get that in every industry? But there is a hell of a lot of rogue behaviour inside banks as well. So why are they favouring banks right now? Why are they going to get away with it potentially? And, you know, why are they targeting brokers? Why are they annihilating healthy competition? You know, the last time when we had a downturn in 2019, you know, banks like Bank of Melbourne, St. George, they used to be independent. Who owns them now?
The big ones.
The big ones, exactly right. The banks own them. They slowly buy them out.
Do you think brokers will still exist?
Yes, I do.
Okay.
Yes, I do. The short answer is yes. I think they're going to weed out a lot of brokers that are going to find it all too hard. But the good ones will survive. The good ones will transition and evolve.
And then can I ask a separate question? Why would you still go to one?
Great question. And you know what? Because, you know, hubby and I were talking about it last night. You know, what would we do if it happens, if it doesn't happen, talking about different scenarios and possibilities. For us, I don't fit most of the banks. I don't fit inside their box. I might with one lender be, maybe not the rest. And I don't have the time to go through and study all their products. So I would stick with a mortgage broker because they've got access to non-lenders as well. And for that reason, they'd be able to do all the research for me and find me a product or a couple of products that would really suit my circumstances and my strategy moving forward. So they'll always have a place.
Nice.
Okay, it's important that people understand that, you know, brokers, good ones, when they're of service, really do help people. In fact, I was just talking to my broker this morning, or one of my brokers, and they were saying, Helen, you know what was really interesting, because, you know, we've all been talking about the Royal Commission, and she said to me, I just spoke to a person last night, an investor, who said, I've gone to 4 different brokers, and 4 of them said to me, I can't get a loan. And this investor had some properties, wanted to refinance, get some equity out and go buy some more property. 4 different brokers said no. Yet my broker looked at the situation and said, well, of course you can. And I can do a pre-approval for you to now go and buy 2 more properties this year. Yeah? Right. And that's why choosing the right broker is pivotal. And here's why. At the moment, 60% of loans go through brokers. Okay, 60% of mortgages go through brokers.
That's a lot. Yeah.
Absolutely there is. But of that, 40% are declined. 40% of mortgages that go through brokers are declined. That is friggin' huge.
Yeah.
However, my broker, because I asked the question and got them to run some numbers, for 2018, they had a 94% success rate of getting loans over the line, getting loans approved.
Matter of finding a good broker.
Exactly right. Exactly right. And that's the pivotal thing. We're getting to a point where you now need to look for a panel of experts that are investors themselves, that understand what's going on, that understand and are at the cutting edge of all the changes that can actually help you get your loans over the line. Because as we said earlier, David, banks want to lend. They're in the business of lending money, but they've just got to make sure that you tick all the boxes. Gone are the days where you can flick them a couple of pay slips and a tax return and they go, sure, here's $500,000 for you. No, that's where the landscape has changed. But with all that's gone on now this week with the Royal Commission, etc., there is some good news. The good news is the media frenzy of all the recommendations, changes, findings that have occurred over the last 18 months to 2 years are going to come to an end. So their 15 minutes of fame is going to end soon, and that we'll all be able to get on with life. Things will eventually settle down. So it's important that again, everyone listening, savvy investors march against the crowd and realize, okay, this too shall pass, and this too will settle down. And with findings now being, laid out for us all to see, it means that we can all start implementing them and getting on with life. Let's talk about interest rates for a moment, because that's also on the list. I reckon interest rates are going to come down, and I think they're going to come down and then stay down for quite some time, at least for another couple of years. I don't see things moving upwards anytime soon. So for any of you with loans, negotiate your rates, and really try and get the best rate you can, because now's the time for it.
On the news yesterday, when they announced the rates, they were saying that it could actually go down again, the cash rate.
Yeah, absolutely. I think they're going to wait to see what the fallout of all of this is going to be, and whether the market still continues to decline. You've got to understand, it declined right up in the lead up to Christmas, which is kind of traditionally anyway, things slow down. And, we're January, all school holidays and on holidays and what have you, and the year's starting to gear up. So I think, watching the market over the next couple of months will kind of give them an insight as to what will kind of happen moving forward, whether Australians start to feel more comfortable, whether the sentiment becomes a little bit more positive. After the election, I think it's going to, I think we're going to stay kind of really quiet until after the election. So we've also got that into our future that we've got to deal with. And with Labor kind of talking about all these bloody negative gearing changes and what have you, it's going to be what it's going to be. I personally just adapting the strategy according to what's occurring. I can't predict what's going to happen. I can guesstimate, but until it's written in black and white and it's legislated, it's all speculation. So what we want to do is kind of prepare for that. So, now is definitely a good time to be buying. We're looking for the new stocks so that you can maximise your depreciation and what have you. We'll talk a bit more about that. I've got a few slides to share. But it's really important, more so, that people understand finance. Folks, finance is the key to all of you moving forward. That's what we need to be doing, focusing on finance. So can we talk about the new rules of finance?
We can. Let's go.
Excellent. All right. Well, we all know that a tightening lending criteria has made it tougher for us to get finance. But once you learn how the new rules work, it is easy to get finance. So it's really about responsible lending. That's really what the Royal Commission has been about, making the banks more responsible. And let me tell you, I know of people who have loans, mortgages, who should not have them. They are in a world of stress, a world of debt that they should never have been allowed to have. And one of those people, is a family member where I look at them and go, how did you get that loan? It's beyond me. They couldn't get that loan now. But back in the day, they managed to get it because of, low doc lending and the lack of stringency around what you can declare or what they ask you and what have you. So a lot of people are in a world of pain and will continue. And, my advice is sell. If you're in a world of financial pain, sell it. Get rid of that financial stress. Don't hang on trying to kill yourself, because you're not having a life. You're not even existing. You're sub-existing. It's shocking, and no human should live like that for the sake of a mortgage. You're better off just starting again fresh. So it means that you really need to be looking at budgets. You need to be budgeting, because the banks are going to look at it, as well as your credit cards. And I say this all the time, David, you've heard it 50 million times. For every $5,000 you have in credit card debt, it limits your borrowing power by $25,000.
Yeah.
And that could be the difference between getting the loan and not getting the loan. You need to start keeping track of your spending. And I want to give an example of using cash for incidentals. So again, talking to my broker, they were sharing how a young couple in their 20s wanted to buy their own home. And they were really excited, earning good money. One's a tradie, one's a teacher. But unfortunately, when he started asking for bank statements and what have you, he scrutinised and looked through the bank statements as a bank assessor would. And what he'd noticed that there were regular weekly transactions, cash withdrawals, from an ATM at the pub. And normal brokers would have just glanced over it and lodged that loan and got a decline. However, what my broker does is went back to the customer and said, listen, I know that the assessor's going to say, literally, he showed me these statements because I had to have a look. But there were several entries. You know, you could see the wages going in, rent coming out, and then disposable income, bang, 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 bang. You know, up to 5 times in one day, $100, $100. You can't tell me you're there for dinner and a glass of wine or a couple of beers.
Yeah.
You know, you're there spending money like crazy. So what he got this couple to do was to go away, redo their budget, and spend the next 3 months cleaning up their statements. You want to go to the pokies, you want to go and gamble some money, personally, don't do it. However, go to the ATM maybe at the shopping centre or, you know, close to home or main shopping strip. Withdraw out a couple $100 or whatever the amount is and just use that. Don't be tempted to use your ATM card or your credit card. Leave them at home so you're not tempted.
I was going to say that. Don't do that and then leave your credit cards at home and put money in your pocket.
Exactly right. So we don't want to stop people from having fun and, you know, doing whatever, as long as it's not dangerous, like, you know, gambling or whatever. You know, even if you're going to go to, say, Crown Casino, you know, you go to Crown Casino, there's bars there, there's cinemas there, there's restaurants, there's shopping. Don't go to an ATM there, you know, and draw out money. You know, it's okay if you use your credit card in a restaurant because the assessor can see that. But what was most interesting with this young couple is they sent an email saying, it's been 3 months now, you know, we've been doing XYZ as recommended, and there's a couple of transactions at the pub. However, we've got the receipts to say it was for dinner and meals, in case the assessor asks the question. Well, happy days, you know, they tick every other box.
Yeah.
So this is the difference between my broker getting 94% of loans over the line, or one of the areas. It's about educating people to understand money management and how to manage your money, rather than just going, oh yeah, give me your 3 months worth of bank statements and, you know, the broker lodging it with the bank and getting a decline. So you've got to use cash for your incidentals. When you do your budget, you know, you want to go and buy a pair of shoes on sale for $90, just rip out cash. You know, have your lunches for the week if you like to go and buy your lunch when you're at work, or your coffees. Just give yourself a budget of $50 a week and spend that on your coffees. Don't let the assessor know what you're doing with your life. They don't need to know, you know. Give them, you know, there's stuff like that they don't need to know, because let me tell you, they're holding it against us. Things like, you know, adult stores and stuff like that, you know. Be mindful of when you go shopping, folks, is what I'm saying, because it can play against you. And I know that a lot of these sexy land stores and what have you operate under different names, you know? But some of the assessors are getting, you know, twigging to this sort of thing. You know what I mean? I know it sounds ridiculous. I feel ridiculous even saying it, but I'm sharing it with you because I know it stops people from getting loans.
Yeah, I've heard they sent different names. I'm not sure.
Say that again?
I said I've heard them send it under different names. I'm not sure.
Yeah, they do. They use different names, but some of the assessors are twigging, is all I'm saying. All right, let's keep going.
Yeah.
So I want to share with you now, from an educational perspective, how choosing the right property is really going to play a major role moving forward with your investing. So let's do a comparison on a couple of properties. David, tell me, which one would you choose?
I knew you were going to ask me this. I think I'd go the property 2.
Why property 2?
More established.
Okay.
I'm looking at the house and it's got the driveway, it's got the lawn. It just looks better, I guess, in my eyes, and there's less for me to have to do.
Well, the property one is brand new. You don't have to do anything. There's a driveway there. Okay, there's some, pebbles in the front and some tan bark and some plants that will eventually grow. But wouldn't you want property one because of depreciation?
Yes.
All right, let's have a look at it.
All right, go.
Okay, so when it comes to choosing the right investment property, you do need to do your research. You need to understand the market. Okay, so how do you do that? Talk to lots of property managers because they're in the market. They're at the cutting edge of what's going on with tenants. They're living and breathing this every day. So what you want to ask them is the question around, what type of property rents 365 days of the year? Is it a 2-bedder, 3-bedder, 4-bedder? What is it? And if they go, oh, it's 1-bedder, then you look at 1-bedders. But, based on what they say, you need to start drilling down and focusing on what tenants want. So, for example, what I often do is when I talk to a property manager, I'll say, right, okay, what type of properties do tenants want? They go, 4-bedders. Okay, great. Do they want single garage, double garage? Yeah, they prefer double garage. That one rents quicker than the single garage. Okay, great. So I've got 4-bedder, double garage. I go, what else does it need to have? I go, look, people prefer floorboards, but they'll accept tiles. Okay, so I want floorboards. What about air conditioning? No, ceiling fans are enough. Okay, great, so ceiling fans. What about dishwasher? Yes, mandatory. What about backyard, undercover, fresco, study, blah, blah, blah. I ask all the questions.
Yeah.
When I ask all the questions and they give me all the answers, and I go and do that by interviewing 4 or 5, 6 property managers, at the end of it, I've literally got a shopping list, haven't I?
Yeah.
Yeah, and that's what I use to go shopping for real estate. I don't sit on realestate.com. I then give that shopping list with my budget to a sales agent and let them go and do the hard work. So it's really important when you're choosing the right investment property that you're choosing what tenants want and what's in demand for that suburb or town. So here's some facts. Twice as many Australians rent now than they did back in 1981. 4.5 million Australians live in private rental dwellings. Now, the private rental market is no longer a transitional thing. It's really becoming about lifestyle, which is, really interesting that people are going, I'll rent where I want to live, but invest where I can afford. And that's a key thing. Okay. And 1/3 of tenants have been doing this for more than 10 years. So there's a whole bunch of tenants that are making a lifestyle out of renting.
It's quite amazing, isn't it?
Yeah, it is. All right, so let's look at a case study. This is the Griffins, potential tenants. This is Jane and Joe, age 30, 32. Jane is a personal assistant, whereas Joe's an electrician. They've got 2 kids. Sam is 7 and Elizabeth is 5 years old, and they've got a little dog named Fluffy. So let's have a look at what the Griffins want. Now, they want a 3-bedroom house that's modern. They want a family-sized bathroom, dishwasher. They want air conditioning and heating, outdoor area for the kids, and they're happy with a single garage. So let's go back to these 2 properties and let's take another look at them, but this time in a lot more detail. Let's go with property number 1, the builder's special, as I like to call it. So here it is. Sure, it needs a few more plants at the front, but it needs a hell of a lot more than that. Have a look at this family kitchen. Imagine cooking a meal for 4 people in that kitchen. To me,
where's your island?
There is none, David. That's part of the family meals area. That's where you put your kitchen table to eat. Yeah, exactly. So for me, this is more of a kitchenette. I would put something like this maybe in a 1 or 2-bedder, but I wouldn't. But even then, I'd still want a little island bench somewhere, not in a 3-bedroom home catered for a family. Let's have a look now at the family bathroom. Where's the bathtub?
I was going to say that there's no bathtub. I've got 3 kids, so you'd need a bathtub.
Exactly right. And in fact, a lot of the time, when you rip out a bathtub, you actually devalue the property.
How funny.
Yeah, absolutely. Let's have a look at the backyard. gee, there's only a metre square for a little Fluffy to do its business. The rest of it's tan bark. Imagine the kids running around amongst all that tan bark.
That'd be fun to sweep up afterwards.
But really, this is what, unfortunately, this property's in Melbourne.
Yeah.
And I'm sorry to say it, but you interstaters that are on this webinar, you guys are the ones that buy this crap off the plan, thinking you're buying a lovely 3-bedroom investment property and get stuck with a lemon. And it's really sad when that happens, you know, and the reason why you came unstuck is because you didn't read the plans very well. You kind of trusted the person who sold it to you, or you got caught up in the hype at these seminars where all they're trying to do is sell you real estate. And this is the end result. So let's now have a look at property number 2. Albeit a year old, here's the kitchen. It's a family kitchen. You can cook a meal comfortably for 6 people if you've got guests, and you can enjoy that kitchen. You've got plenty of space and room even for a bigger fridge. The bathroom. Lovely bathroom, has the bathtub, a separate shower and vanity. You know, all done for you. You've got room to move. And the backyard has a space for Fluffy and the kids and a trampoline and whatever else. You could add value to this property by adding a little, putting the table under cover. You could extend out and put it under cover. But still, it's a lovely backyard, and, you know, compared to property number 1, this is far more appealing. In fact, what I often say to my clients, guys, see the garden bed. Doesn't cost much to go down to Bunnings or a nursery and buy some bigger plants. Spend a little bit more and put them in and make it look more established. And that also adds to that whole feeling in the backyard of it being more established and more appealing rather than just tiny little plants.
That AstroTurf.
What was that, sorry? You're looking
That
at that?
AstroTurf.
Ah, yes, it's fake grass. Yes, some people love it. I don't. Anyway, let's compare the 2 properties. So property number 1 rents for $370 a week, but it has an annual vacancy. So there's high turnover of tenants, which means high running costs. Every year you got to pay the property manager another week or 2-week letting fee to find you another tenant. Whereas property number 2 rents for $50 a week more, plus tenants stay. So just on the cash flow alone, you're earning an extra $2,500 a year in income, and you have less vacancy. So for those of you concerned about negative gearing, you know, sometimes you want to weigh it up going, is the established property going to give me a good rental return over and above something new? If so, you know, if it's got more features and what have you, consider it. Can you add value to that established property and not be so hooked on negative gearing and, you know, being able to, claim depreciation? Albeit it's really important to us investors, so I'm not discounting that, but it's got to be based on your personal strategy, your risk profile and your time in life and where you're at and your budget and all of those key things when it comes to creating a strategy. So for clients who are on this webinar, guys, if you're coming to the Property Academy, I'm going to go through this in a lot more detail, especially around due diligence, because it's a vital part when it comes to creating your strategy. All right, so let's continue. We're still choosing the right investment, but now I want to give you an example of buying off the plan. Now, floor plan number 1, and these are legitimate floor plans that cross our desk, that get sent in to us by our clients for us to critique, to review the deal. Does it suit the strategy? Does it tick all the boxes? Now, if you have a look at this one, it's a 4-bedroom property.
Yeah.
It has a kitchen, meals, dining area. Fantastic. It has a family area, but it also has a separate rumpus. And I say to everybody, you know, if you're going to buy a 4-bedroom property, you must have 2 separate living areas. Even if, whether it's for a family to live in or maybe 2 couples or 2 individuals to rent, you want to have 2 separate living areas and 2 bathrooms because it makes it a much more palatable property to live in, and therefore they stay longer. So that's really important. So if you're looking at 4-bedroom, even 3-bedroom, I always look for two living areas where possible. It's harder when you're looking at inner city capital areas. You don't necessarily have the space. But if you're going further out and you're in the mid-range, sort of the 20, 25 kilometre onwards, you want to make sure that if you're looking at a townhouse or a unit, that it has a couple of living areas and especially 2 bathrooms. Floor plan number 2 is also a 4-bedder. But here's the thing. You've got your kitchen, you've got your meals, and you've got your living space all in a tiny little area. Look at the dining table. It's a setting for 4. But if you sat in that chair and pulled the chairs out, you'll be banging against the couch or banging up against the kitchen bench. Now, what this floor plan is not showing you is whether that kitchen bench or island bench should have bar stools behind it. They didn't draw them in. There might be an overhang. So it'd be really weird. You wouldn't be able to pull out a bar stool and a dining chair at the same time. It would be really cramped. And, you know, there is no separate living area. It's just bedroom after bedroom after bedroom, and it's just too small. Even though there's 2 bathrooms, it's just all small. And so, in my opinion, this would be a higher risk property where you'd have a higher risk of people constantly moving out and, you know, moving in. So you don't want that. Here's another floor plan that a client sent in to us for a bit of fun. Have a look at this. It's got 2 bathrooms. It's a 1-bedroom, 2 bathrooms. Now, they've got a double garage. But there's a door between the garage, obviously allowing people to potentially close it in and make it into another bedroom. However, if that was a genuine 2-bedroom unit, it would have been approved by council because the developer would have done it. So it says to me that the council didn't approve it, so they made it into a tandem garage to get it over the line and then put those doors, bifold doors in place, hoping that you might use it as a 2nd bedroom. But then let's look at the ensuite. The ensuite and the bedroom are separate, which is fantastic. I don't like en-suites where you've got to go through the bedroom to get to the bathroom, because if you've got guests over, they're going to go through your messy bedroom to get into your bathroom. So having it separate like that is fantastic. But if you look at the bathroom/laundry, there's a toilet in there. Okay, do you need the toilet in there? Do you need 2 toilets? I mean, I guess it's okay, but I would have preferred more storage in the bathroom. So for us, that raised a red flag. But the irony is this property was built, so our client sent us the photo. Have a look at this property. Yeah. Do you see anything in particular?
Oh.
Yeah, that's the toilet. So we cracked up laughing when we saw it. You're sitting there and you're having a lovely view of the backyard. I hope the neighbours can't see you.
I was going to say, you know how builders quite often will name their range? Is this one called the Exhibitionist?
Yeah, probably. So you really need to understand how to read floor plans so that you can target your property to tenants, as this will help minimise your risk of having a low-performing property. So the poor Sydney-sider who was trying to sell this had a bit of trouble, you know, and I'm not surprised. So for all of you, you know, when it comes to buying property, this is where a mentor can really help you nail these kind of nuances and stop you from potentially buying a lemon.
Did they get bogged down in the sale?
Sorry.
I'll leave now. My time is done.
Yeah. Oh, too funny. So let's talk about why educators will get better rental returns in 2019. And this is where we're going to start with the data, okay? So this is CoreLogic data that got released this week. And again, guys, as a bonus, I've made this available for those of you that stay to the end. You'll get a copy of this. So reviewing the whole report, it was obvious the top performers were the hotspots for the past 12 months. And what was interesting is people often think they can't negotiate. However, the report actually showed that there was discounting going on, and some up to 10%. Now, if you reflect back on the last 12 months, say 2018, the property market didn't decline as of January of last year. It kind of, you know, slowly went a little bit quiet and then took a bit of a dip closer to Christmas. But what was really interesting, David, is the large ratio of the top performers was small areas. So, areas that had really small populations of 2,000 to 3,000, for example, country New South Wales towns where the population was on the decline. So this is where I am so anti-hotspot, because you could get this report and have all the performers up the top for the past 12 months, they're there. But if you're not looking at the fundamentals, and the fundamentals are on the decline, how is that a good thing? How is that a hotspot? And I'm not surprised that these hotspots able to get, really extensive discounts. In fact, right now, everybody should be negotiating and not be paying the asking price. We've got an opportunity now to be really enjoying discounts on the properties that we're looking to buy. So you need to be doing that. I do it all the time. I'll give you a quick example.
Yeah.
So when I go in to negotiate, let's say the property is $400,000. I will befriend the agent. He'll know I'm an investor. I'll give him my budget, blah, 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 blah. And then I'll say to him, listen, he presents me with a property and my starting offer will be $320,000. And I'll say to him, I know, because he's going to balk at it. And I'll say to him, listen, Joe, I'm not trying to be offensive, but the fact of the matter is I need to get a couple of properties out of my borrowing potential.
Yeah.
And by paying less for this one will allow me to get that second deal. So I'd really love it if you could help me with a second deal. And so I know that the vendor's going to object. However, I know that they need to move this property on. So if you can help me out here, that would be awesome. It means I can come back to you with a second deal. Mm-hmm. And so I'm being truthful. I'm not lying. I'm being really fair and upfront, but I'm explaining why I'm coming in at a lowball offer. And right now is really the best time to be doing that. Would have been harder 2 or 3 years ago. I get it. I'd still be going for at least 5 to 10%. But we're coming into some of the best buying times as it's becoming a buyer's market. So I really want to encourage everybody to start really low, because when you start low, you can always come up. All right, okay, all right, I'll give you 350, or 352, all right, 358, and you can crawl up in small increments until you kind of meet in the middle. So my point is, don't be afraid to ask for discounts, especially now that the market is priming itself for that.
And also, I just want to bring up something else. Like I said earlier, I've known you for quite some time. You're not a big hotspotter. You think that's more of a buzzword than anything else.
Correct. Yes, I am.
It all comes down to education and research.
Absolutely, David. It's all about education. And with the next couple of years, education is going to be the key to building that portfolio and having the right panel of experts around you. So let's have a look at some SQM data that's just come out as well. Again, I'm going to share this with you guys. They said in December, the vacancy rate rose by 2.5%. Do you know what that means? It means there are now more rentals available. Oh, I was a bit shocked by that number, because I'm kind of going, no. It's the other way around. However, when I continue to read the report, it says, despite a rise in vacancies, capital city rents for houses and units rose by 0.7% over the month to January the 12th. Ah, interesting. And then the managing director goes on to say that the vacancy increase is due to seasonability. Now, what does all of that mean? Well, we've got vacancy rates increasing. But at the same time, in a quiet month of December, Jan, we've got rents rising. And the managing director is saying it's all seasonal. Well, let me tell you, I don't have my rents come up for renewal in that period of time, December, Jan. Whenever I am renewing a lease, if it comes up for renewal in November, and we're renewing it for 12 months, I'll make it a 9-month lease or a 14-month lease. So I get to renew it either before Christmas, way before Christmas, or right into the new year. I avoid the December, Jan period because I don't want to have to experience the seasonal fluctuations. So when is the best time of year to renew your rents? March, April, May.
Yep.
And then June, July, August, September. are the better months. And again, you can read the data yourself. It will show you the better months to be having your lease come up for renew. So that's really important. And, you avoid that seasonality. Great that rents have risen over December, Jan. That tells me that there is a shortage of quality stock. All right? So we'll go into that. Then this week also, ABS released their data around building approvals. So
it's a big week for data, isn't it?
Yeah, and again, there's so much more to this data. Again, I've just taken a snapshot. So again, I'll provide this data at the end. But it was released this week. It shows that dwelling approvals for units are on the decline, sharp decline, and private sector houses approvals are also on the decline. So have a look. We've got vacancy rates rising, but rents are rising. Building approvals are on the decline. What does all of that mean? Let's have a look at the fundamentals. The housing market right now, everyone, is fundamentally sound. It's sound. We've got immigration is strong. We've got 100,000 plus people coming into this country. They need somewhere to live. They rent first to settle in before they look at buying. They need to secure employment, a credit history. They need to qualify for a mortgage before they can buy. We've got 35% of the population renting, and it's growing. But there's a shortage of quality housing. I hope you all hear that. It's quality. It's not high-rise apartment blocks, towers. It's not cheap and cheerfuls, as I call them, that are going to be the commission homes of the future.
and from experience, don't get us started on high rises.
Exactly.
You don't like high rises?
I do not. High rises are okay. So I know we sent out an email last night asking for people to send in some questions, and people were saying, "Oh, Helen, I bought a property on the Gold Coast. Do you think the Gold Coast is going to grow?" No, even if it did, your high-rise off-the-plan apartment will not. Sorry to be the bearer of bad news, but will not. And I can tell you why. Because in talking to my broker, he tells me that investors that contact him who have bought these off-the-plan deals are coming unstuck because they're trying to settle and the valuations are coming in 5, 10, 20% lower than what the contract price is. And they're struggling to get them financed because the investor doesn't have enough deposit money or has to scramble to find it somewhere. So they're going for lenders at much higher interest rates to just secure the deal. Otherwise, they're going to lose their deposit money. And folks, for those of you that are close to retirement and have been suckered in to these seminars where they're selling you off the plan deals, you are the group where my heart breaks the most. Because you're getting close to retirement, you thought you were doing the right thing. I hear all of that, but at the end of the day, most of them have bought a lemon. So you really need to work with a mentor, your finance broker, etc., to look at how you can undo that mess so that you're not taking that into retirement with you. Because I promise you, that type of property will keep you working longer. So if you're wanting to retire, that is the type of property to avoid. All right. Do you want to hear what my predictions for 2019 are?
Yep, we've just clocked over the hour mark, so let's go.
All right, here we go. So I think that 2019 is going to be a great opportunity for people to get into the market. A lot of people have been saying to me, Helen, I'd really love to invest in this year. So they're sort of telling me they're looking to be buying in the next 3, 6, 12 months. Thumbs up to you. Awesome. Make sure you do it. Let's make it happen. You've got to negotiate on price. We have a window of opportunity. Remember how I said everything works in cycles? We've got 18 months to 2 years to get cracking on negotiating prices. So please don't make sure you buy at market value. Get under market value, because that will protect you from let me have a glass of water. That will protect you from negative equity positions, okay? So you want to beef up your buffers. You want to protect yourself so that you ride the cycle. You want to buy only quality housing that people want to live in. Now, I'm not talking about Calcutta marble bench tops, okay? Buy that for yourself. But, stone bench tops are good instead of laminates or laminates. Timber floors, even if it's laminated timber floors, are still more appealing. Get stuff that people want, but don't overdo it. Now, interest rates are likely to drop, and then will eventually stabilise over the next couple of years. So I'm not seeing increases in interest rates over the next couple of years. And realistically, folks, now is the time to get educated and understand what you're doing. The days of buying a dog box in Sydney or Melbourne, making $1 squillion out of it are over, at least for the next, I would say for Sydney, 5 years. But for the rest of the country, the next couple of years. Sydney's going to stagnate for a while. They're going to go through a renovation boom until wages pick up. So for your Sydney-siders, watch the data that comes out on wages. As Sydney-siders' wages increase, it gets to a point where they go, oh, happy days, I can now afford an investment property, or they upgrade their home. So that's generally what happens for Sydney. But now is the time to really start, getting your mentors on board, working with a panel of experts that are investors themselves that can really help you expand your portfolio. All right. So as part of this, we're opening up applications for our peak mentoring programs, and there's the link on the screen for you guys to apply. But guys, for those of you that have been asking, we do have a handful of opportunities available for you to work with us. Now, we don't take everyone. We are selective because it's our reputation on the line. So if you're going to need to know, so we're going to need to know if you're serious, okay? We need to know that you're committed, that you're open to learning, etc., and that it's for you, okay? So it's really important that that you can get the results like many of my clients. So just go to the application page to apply. Next, you'll receive a call from King. He's my action coach. He'll get to qualify you and ask you the card questions. You'll get to ask him a bunch of questions, and really there's a reason for this, okay? We want to make sure that we just don't take anyone. Some people will just take your money, whereas we don't think that has integrity in it. So we feel if you're not a good fit, then we're not a good fit. And that's just the way it is. So if you're interested and if you're serious, then fill out the application form and have a chat to King. He's made some time slots available and he'll be in touch. So that's really important. Just go to the link and apply. Let me share some stories with you. I've had lots of testimonials, and again, these are testimonials of clients, thanking us, like Dominic. He says the mentoring program gave him the control to take over his future with the support and guidance of a knowledgeable mentoring team. And that's really what we're about. Whereas Elizabeth says the mentors were incredibly helpful. Some of the information I came across put me off the property, but after running it by the mentors, they provided a different perspective. And that's what we do. We always look at every possibility. How do we maximize what you've got? Paulina says, she'd like to thank us for our support, that we're always there for her, which is really part of the process. That's pivotal. And it makes such a difference, as my real estate journey is never alone. And guys, when you've got that level of confidence and someone, standing behind you and guiding you, it makes it easier to have the guts to face the crowd and to move forward. And Zelda says the property mentoring program she bought property number 4 through the program. She learned so much during the progress working with us and is really happy with her results so far. Then we've got Chris and Jason. Well, these guys are superstars because they were negative 600 grand when they came to us back in 2015, made a bad financial decision. We helped them turn it around. And last year they bought their 8th property. Even with the title lending rules, even with APRA and the banking commission, Royal Banking Commission, etc., they went on and bought their 8th property. And a couple of those properties are all about doing developments. So we're working with them on the developments. Then we've got Jared. He's working 4 jobs. He had massive debt back in 2015. He too turned it all around and has just bought last year his 8th property, looking at his 9th property, and is still going. So, folks, when you've got support and guidance, it makes it easy. It's really important that having a mentor and a panel of experts, like my brokers are all investors as well. They understand strategy, they understand how to get properties over the line with the banks, and are really at that cutting edge, place where they're really making a difference to all the clients. So how do you determine if we're a good fit and whether the education is right for you? Well, just book a call, have a chat to King, and he'll be able to go through it all with you. But I want you to understand, we live and breathe property every day. So we are across all the changes so that we can maneuver and adapt our way forward regardless of what's going on. And this is what makes us market leaders in property education. I've been at it for 13 years as of February 27th. This will be my 13th year in business, and I've never sold real estate. I will not sell you a development or a piece of property. The team and I only review your deals and teach you how to do it for yourself. And so to be the cutting edge of education, you want to work with people like us that will really fast track your investing. So like I said, there are limited spots available right now. And we may not be able to accept everyone, but we're going to have a conversation and let's see what we can do to help you. Okay, so I want to say thank you for staying to the end. We're going to have question time now, but guys, here's the link to go to where you get all your bonuses. And just for those of you that are listening, don't panic if you don't have pen and paper. We're going to email it to you at the end of the webinar. So later today, we'll send you the link where you can download all the bonuses. All right, question time. How are we going? Are we?
We've got a few, time? And we've got a few minutes to have a crack at a couple if you'd like to.
Yeah, absolutely. Bring it on.
Look, let's go for Hayley. She put one in a while ago saying, can you renegotiate on a fixed rate loan?
You can't, no. It's fixed. It's done and dusted. Sorry, Hayley. You got to ride that one out. If you do refinance, what you could do is talk to your broker and look at what your exit costs were going to be. If you've had the loan for a while, it might mean that those exit fees are quite low. Where, I know of a client who did that. It was going to cost, I don't know, about $1,500 to $1,800 to exit out, and they made the decision to do it because the possibility of refinancing to a better product that had terms and conditions that suited them, that suited their strategy, and was a lower interest rate worked best. It was in their best interest. So the short answer is no, but you can look at seeing where you're at with your fixed loan.
Melanie just wanted a quick question. Would you suggest giving property managers a call or via email? What works best?
Look, I prefer to have a conversation with people. Being in the game of property investing is really about building relationships. And it's hard to build a relationship with someone over the email. So start off with a conversation. You ring up, hi, Sally, I'm an investor, I'm looking for a property manager, and I need to ask some questions. Do you have time for me to ask you a few questions now? Or can I email the questions to you? You can, answer them and send them back. What's easier for you? And then let them choose. But start off with asking, having a conversation and building that relationship.
Okay. Helen from James said, where do you see Brisbane inner city 2-bedroom apartment market heading over the next 5 to 10 years? Would you invest there?
Good question, James. Would I invest there? It's not my strategy to invest in a 2-bedder Brisbane property right now. However, if it's what tenants want, and it's in demand, and it's in a desirable area, then yes, if the fundamentals stack up and it suits your strategy, then it should be fine. If it doesn't suit your strategy, then you could have a lemon. So it's a yes and no answer, I'm sorry.
Okay. Mandy has asked, she's looking at investing in a property, and she has said, I'm more in favour to buy in either Sydney or Melbourne for a long-term holding for the next growing cycle. I've been hearing a lot of the experts predict that Brisbane is the next to boom in the next 2 to 3 years. I see Sydney and Melbourne prices are falling. Where would you look at? I should actually put my glasses on so that I can read these properly.
Yeah. I would be going to areas where your strategy dictates. So, guys, your strategy dictates where you buy. That's the first thing. And so, like I said to clients, guys, running that Property Academy next month, come along to that, because I'll be able to take you through how to create the strategy and how strategy dictates your purchase. But to answer Mandy's question, I would utilise my strategy for purchasing in areas where there are good quality property in a falling market, so I can negotiate bigger discounts and enjoy the next boom cycle.
Okay.
That's what I would be doing.
All right. And by the way, if anybody wants to have a look, check out realwealthaustralia.com on the page at the moment and fill in the application form and you can have a chat to the team there. Narelle, are banks allowing interest-only loans for investments, or are they approving P&I loans? Are they still allowing interest-only loans for investments?
Are they? Okay. Yes, they are. Here's the thing. APRA have taken away the rules around forcing banks to go to P&I. They've eased off on that and they're allowing interest only again. However, the banks haven't eased off yet. So the banks are still keeping it tight, but it is possible is the answer. Again, a good broker will help you with that.
Okay, and what effect will, this is from Desi, said, what effect will the dropping property prices have on releasing equity on current properties to buy more properties?
Yeah, tough. Yeah, so again, a good broker will help you with that, Desi. If you've got property that's in a negative equity position, that might impact your ability to buy. If you're just wondering, if you're concerned about the overall market dropping, well, if you can prove, or if it can be proven that there is growth in your properties and you've got serviceability, then again, with a good broker, should get you over the line to buying more.
Nice. And David has written, which banks or lenders do you currently deal with?
Oh, good question. So I don't deal with all the four majors. I keep things kind of separate. So I got asked this question actually last week. It feels like the other day. Someone said to me, "Oh, Helen, do you have all your savings accounts and credit cards and a mortgage with the same lender?" And the answer is no. So my business banking accounts, my private banking accounts, and my credit cards, one credit card is with CBA, and my mortgages are with everybody else. But I have a combination of major banks and second-tier lenders, so I spread it across many. No. I don't want to name them all because, again, what might be right for me may not be right for you. Again, a good broker will help you with that.
Nice. Well, look, that's all we've really got time for at the moment. And if you want to find out more about the Peak Mentoring programs, please click on the link and you can go through the application process to have a chat to you guys. We'll have a chat to them and have a talk to them. And those are your predictions for Australia's 2019 property market. Helen, thank you very much. And thanks to everybody that posted up questions and that jumped in as well this afternoon.
Thank you, everyone. Thanks, David. That was great. Ciao.
See ya.
Bye.